Something just broke a streak, and if you have spent the last week watching gold and silver bleed lower with no floor in sight, you need to hear this before the weekend closes, because what happens in the next 48 hours in a conference room in Geneva could decide whether this morning's bounce is the start of a recovery or one more trap before another leg down. So before we go any further, tell me in the comments right now, are you holding, buying, or staying out of metals through this weekend? I want to know what side of this you're on, because the answer to that question is about to get a lot more complicated. Gold is up close to 3% this morning. Silver is up nearly 5%. After 5 straight sessions of losses, after gold touched a 6-month low just yesterday, after silver looked headed for its 5th consecutive weekly decline with absolutely no support level in sight, something changed overnight. And a move of this size on the same morning in both metals at once is not a small thing. But it is also not by itself proof that the bleeding has stopped. The gap between those two readings, this is the turn versus this is another head fake, is the entire conversation today, and by the end of it you will understand exactly which variables decide the answer, and when. Let's start with where things actually stand, not the headline version. As of this morning, silver is trading at roughly $67.50 to $68 an ounce, having touched an intraday high near $68 before settling back slightly. Gold sits around $4,220 to $4,246 after touching a high above $4,260 earlier in the session. Those are real numbers and real moves, the first meaningful upward push either metal has made in nearly a week. But here's the part that matters. Gold is still on pace for its 2nd consecutive weekly decline, even after today's bounce. Silver has been down 5 sessions in a row heading into today. Gold touched a level yesterday that erased every gain made since the start of the year. That is the hole this morning's rally is climbing out of. Keep that number in your head as we go, because it changes how you read everything that follows. So what actually drove this? The proximate trigger is the same one that has whipsawed this market for months: Iran. President Trump canceled planned military strikes on Iran on Thursday and said a deal to end the conflict could be close, possibly signed as early as this weekend in Geneva. When that announcement landed, oil prices fell. And for months now, gold and silver have moved in the opposite direction of oil. When the oil-driven inflation fear eases, the pressure that has been suppressing metals lifts, and they rally. That's the mechanical chain that produced this morning's gains. But there is a second force at work today that almost nobody is talking about, and it may matter more than the Iran headline. The US dollar is weakening. The dollar index has slipped toward the 99.5 to 99.7 range. That matters because gold and silver are priced in dollars. When the dollar weakens, it takes more dollars to buy the same ounce. That relationship is mechanical and immediate. It doesn't depend on sentiment or geopolitics at all. Vice President J.D. Vance made comments this morning pushing back on what he called false information about the negotiations and stated Iran would not receive cash or released funds simply for signing an agreement. Those remarks landed in a market that is already trying to price an outcome nobody has actually seen yet. And that uncertainty is part of what's pressuring the dollar lower. Before we wrap up today, I want to do something a little different. This channel, the John AG, has viewers tuning in from literally every corner of the world, and I am genuinely curious where you're all watching from right now. So drop a comment below and tell me, which country are you in, and which state or city specifically? If you haven't already, hit subscribe to the John AG and tap that bell icon, because that's the only way you'll know the second Geneva delivers its answer, or the second Warsh opens his mouth next week. This community is growing fast, and I want you to be part of it from right here, right now. And then there's the data. The preliminary University of Michigan Consumer Sentiment Index for June came in at 48.9, up from 44.8 in May, beating expectations of 46. That's a positive headline, but the number underneath it matters even more for metals: inflation expectations. One-year inflation expectations eased to 4.6% from 4.8%. 5-year expectations dropped to 3.4% from 3.9%. That 5-year number easing is significant. It reduces the pressure on the Fed to keep hiking aggressively, and lower rate hike fear is, all else equal, good for an asset that pays no yield. So put it together. Iran optimism lowering the oil premium, a weaker dollar providing mechanical lift, and softer long-run inflation expectations easing rate fear. 3 separate forces all pointing the same direction, all landing on the same morning. That's a coherent explanation for why both metals are up sharply right now. But, and this is the part that gets lost in the excitement, none of those 3 forces require the long-term thesis for gold and silver to have changed at all. They are short-term sentiment shifts. they can reverse just as fast as they appeared, and whether they do reverse depends almost entirely on what happens this weekend in a city most people watching this video have never thought about twice: Geneva. Because here's what's actually on the table there, and it is not what most of the headlines are implying. Iran's state news agency, IRNA, has already released the main terms of the memorandum currently being negotiated. That text is public. And what it says, and more importantly, what it does not say, is the single most important thing for understanding what Monday's open is going to look like. According to those terms, there is no agreement, at this stage, on the nuclear file. None. The core strategic issue, the one that has driven the most sustained tension in this entire conflict, remains unresolved. What the memorandum reportedly does is open a 60-day window, 60 days after signing, to keep negotiating on that exact issue. Read that again, because it changes everything about how today's rally should be interpreted. A signed memorandum this weekend, if it happens, does not close the nuclear question. It opens the clock on trying to close it. And there's a second gap in the text that matters just as much. No Iranian commitment, in the reported terms, regarding management of the Strait of Hormuz, the choke point through which a massive share of the world's oil flows. If that question remains open even after a signing, the oil price relief that's currently propping up this morning's metals rally may be partial, delayed, or conditional on things that haven't been agreed to yet. So here's where we stand at the end of part 1. Today is a real bounce, with 3 identifiable causes, all of which make sense. And today is also happening in front of a weekend event that, based on the text already published, does not resolve the 2 biggest open questions in this entire conflict. What happens next depends on how the market reads that gap, and that's exactly where we're headed. There's a pattern worth noticing here, one that anyone who has watched this market through the entire Iran conflict will recognize immediately. Go back to early April. Silver was trading near $72, oscillating on a wait-and-see basis ahead of a presidential deadline for Iran to reopen the Strait of Hormuz. Within days, that situation produced a sharp rebound on talk of postponed strikes, and then, just as quickly, a fall back below $67 when Tehran dismissed the announcement as market manipulation, and the talks collapsed. A few weeks after that, silver climbed back above $74, then $75, on the back of a ceasefire and a weaker dollar, only to give much of it back again as the underlying disputes resurfaced. 3 separate times this year, the same basic sequence has played out. A diplomatic headline creates optimism, metals rally hard on that optimism, and then the underlying issue, the nuclear file, the strait, the actual mechanics of who controls what, turns out to be unresolved, and the rally either stalls or reverses. That history doesn't mean this weekend is the same, but it does mean the burden of proof is now on the optimists. The market has been shown this movie before, and it knows how it ends if the substance doesn't match the headline. Now, here's where this gets genuinely interesting, because the easy story, the one most coverage is running with, is that an Iran deal is close, optimism is back, and metals are recovering. But the actual diplomatic text tells a more complicated story, and the gap between those 2 versions is where the real risk sits going into Monday. Bob Parker of the International Capital Markets Association made a point earlier this week that deserves more attention than it's gotten. Even in a scenario where a memorandum gets signed this weekend, any reopening of the Strait of Hormuz would likely be only partial, not because of politics, but because of physical reality. Months of war have done serious damage to Gulf infrastructure. Inventories are depleted. Security conditions on the ground don't reset the moment a document gets signed. Full normalization of oil flows isn't a weekend event. It's a process, measured in weeks, possibly months, not days. None of this means the optimism is fake. It isn't. The Qatari mediation channel that's been facilitating these talks represents a more structured framework than anything that's existed in this conflict before. And the fact that Iran is publishing its own version of the terms, rather than denying that talks are happening at all, which is the posture Tehran held earlier in this conflict, is a categorically different signal. These are real, substantive reasons this moment might be different from the false starts in January, March, and May, when optimism spiked and then evaporated within days. But, and analysts at Suxton Financial put this about as precisely as anyone has this morning, gold and silver remain vulnerable. Even with the dollar weakening today, the market remains sensitive to both Fed communication and Middle East headlines. Vulnerable is the right word, and it cuts both ways. A market that can move 5% on a single headline of optimism is a market that can move 5% in the other direction if that headline fails to turn into a signed, substantive document by Monday morning. The memorandum, even if it gets signed, removes one layer of uncertainty. It does not remove the underlying geopolitical risk that's been driving this entire correction. And markets, as they have done repeatedly through this conflict, have a habit of pricing in the entire recovery in a single session, days or weeks before any of the actual conditions for that recovery have been confirmed. If you found this breakdown useful, if it's helping you actually understand what's moving these markets instead of just reacting to headlines, now is the moment to hit subscribe. Because next week is genuinely one of the most consequential weeks for metals in months, between the Geneva outcome and what's coming from the Federal Reserve. I'm going to be covering every piece of it as it happens, in real time, and you do not want to be catching this analysis a day late. Subscribe now so you don't miss what comes next, because what comes next might matter more than what just happened. Speaking of the Fed, let's talk about next week, because the FOMC meeting sitting directly in front of us might be an even bigger variable than Geneva. Kevin Warsh is chairing his first policy meeting as Fed chair next week. This is not a routine meeting. Warsh was Trump's pick to lead the central bank, and he has faced direct, explicit pressure from Trump to cut rates. That political backdrop is unusual, and the market knows it. But here's the thing. Economists across the board are saying the Fed almost certainly holds rates steady at this meeting. Not because Warsh wants to defy the president who picked him, but because the inflation data simply doesn't give him room to cut without doing immediate, lasting damage to his own credibility as Fed chair. U.S. producer prices climbed 6.5% year over year in May. That's up from 5.7% the month before, and it's the clearest sign yet of the inflationary impact of the Middle East energy shock working its way through the production chain. Those producer prices flow into consumer prices with a lag, which means the CPI readings over the coming months could be worse than what we've already seen, and the May CPI already came in at 4.2%, the highest since 2023. A Fed chair who cut rates into a 6.5% producer price environment would be making a decision that every economist, every trader, every market participant on Earth would read as politically motivated rather than data-driven. That is not a position any Fed chair, especially a brand new one, can sustain. So the baseline expectation almost universally is rates stay where they are next week. The hold itself is not the story. The guidance that comes with the hold is the story. If Warsh signals the Fed sees room to cut later this year, that's dovish, and dovish is bullish for metals. If Warsh signals that the inflation picture is serious enough to keep the door open to further hikes, that keeps the rate fear premium baked into metals prices and caps any rally before it can really get going. And there's a global dimension to this that adds even more weight to the hawkish case. The European Central Bank just raised rates on Thursday, its first hike since 2023, and upwardly revised its inflation forecasts for both 2026 and 2027. When the world's second most important central bank is hiking and warning about inflation getting worse, not better, that creates real pressure on the Fed to maintain a hawkish posture, even with the political pressure from the White House pulling in the opposite direction. Quantitative commodity analyst Peter Fertig summed it up cleanly in his comments to Reuters this morning. Gold is moving in line with statements from the U.S. president, sure, but the overriding influence remains inflation, and markets are now expecting hikes from the ECB and anticipating the Fed will follow. This is the structural cage metals are currently inside. It's not that the long-term bull case is broken, it's that two of the biggest forces in the world right now, a major central bank hiking and a new Fed chair under intense political scrutiny on his very first meeting, are both pointing toward rates stay higher for longer. And that's the environment this morning's bounce has to survive. So let's put the whole picture together, because by now you understand the forces at play, and what's left is figuring out what they actually mean for where these metals go from here. Start with where we've been. Gold hovered around $5,600 back in January, the peak of a historic rally fueled by falling interest rates, tariffs, international tensions, and surging technology sector demand for metals. Silver surpassed $120 at its own peak. Those were not small moves. That was a genuinely historic run. The fact that gold now sits around $4,200 and silver around $67 doesn't mean that cycle is over. It means the cycle is in a correction and consolidation phase, which is, frankly, what happens after every historic move in every market that has ever existed. The correction accelerated sharply once Trump nominated Warsh to lead the Fed, because Warsh was seen as likely to take a harder line on rates. And it deepened further as the Iran war pushed oil prices up and inflation expectations weighed on assets, like gold and silver, that don't pay a yield. That's the road that led to yesterday's 6-month low in gold. And today's recovery from that low, meaningful as it is, has not yet changed that structural picture. A 3% day does not undo a multi-percent week. This is the beginning of a possible stabilization. It is not yet a confirmed reversal. Now let's look at the actual levels, because this is where analysis becomes something you can use. Silver at roughly $67.50 today is up from the week's lows, but it's still sitting inside the consolidation range that commodity research groups like CPM Group have flagged as the near-term zone. The risk CPM Group identified this week, of a potential breakdown toward the $50 level, has not been eliminated by a single 5% bounce. $50 remains the line that matters on the downside. On the upside, if the Iran memorandum signs and holds, if the Fed delivers a hold with neutral to dovish guidance, and if the dollar stays weak, under all three of those conditions, silver has a real path toward the $70 to $75 range before hitting its next significant resistance. But notice the word if 3 separate times. None of those conditions is guaranteed, and all three need to align. Gold around $4,220 to $4,246 is above yesterday's 6-month low, but it's still well below where it needs to be to break the pattern of lower highs that has defined the last several weeks. CPM Group also flagged $3,800 as a possible downside spike target during this consolidation phase. That level hasn't been tested, which means the risk of testing it hasn't gone away either. $4,200 and change is not the all clear. It's a bounce from oversold conditions inside an ongoing consolidation. That's the honest framing, and honest framing is the only kind that's actually useful to you. So here's the simple version. Today is a better day than yesterday. This week is still a bad week. The month has been difficult. And where things go from here comes down to 3 specific things, all of which resolve within the next 72 hours to 7 days. First, does the memorandum actually get signed in Geneva this weekend, or does the process stall again, the way it has in January, March, and May? Second, does the Fed's guidance next week lean hawkish, or does it lean neutral? Third, does the dollar weakness supporting metals today persist through next week, or does the dollar find a floor and bounce back? Watch Geneva first. If a memorandum signs Sunday and Monday's open shows strong follow-through, that's a real signal a consolidation base might be forming. If it signs and Monday is muted, or reverses, you're looking at the same pattern as January, March, and May, where the optimism was genuine, but the actual resolution stayed months away. Watch the Fed second. A hold with neutral to slightly dovish guidance is the most constructive realistic outcome for metals. A hold paired with explicitly hawkish language about the inflation trajectory caps any rally fast. Watch the dollar third. If the dollar index holds near current levels or drifts lower, that continues to provide mechanical tailwind. If it snaps back sharply, some of today's mechanical support for metals reverses with it. All three of those variables move within the next week. And here's the part that matters most. The long-term fundamentals that built the case for gold and silver in the first place, real interest rates, central bank accumulation, geopolitical uncertainty, and industrial demand tied to the energy transition, have not been dismantled by this correction. They've been temporarily obscured by a specific identifiable set of short-term macro conditions. And those conditions are going to resolve, one way or another, in the very near future. When they do, the picture gets a lot clearer. Today's job isn't to predict the outcome. It's to understand exactly what's happening right now, know precisely which variables to watch, and be ready to understand what each piece of news actually means the moment it lands, instead of reacting to headlines a day late, the way most of the market does. Before you go, drop a comment and tell me where in the world you're watching this from, and what time it is right there. Saturday morning in New York? Saturday evening in Dubai? Sunday already in Tokyo? Late Friday night somewhere else entirely? This channel has people watching from every corner of the globe, and it genuinely shapes how I think about when to publish and what to cover next. I read every single comment. Tell me where you are, and I'll see you when Geneva and the Fed give us our answer. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.